Every founder dreams of building a company that scales, attracts investors, and ultimately succeeds in the marketplace. But the harsh reality is that startups don't fail only because of poor products or weak markets. They fail most often because they run out of cash. Cash is oxygen for startups. You can have a brilliant idea, an inspired team, and even initial traction. But if you don't manage your finances with discipline, you won't survive long enough to realize your vision. This is why financial modeling, runway management, and burn rate awareness are non negotiable skills for any founder. They aren't just numbers on spreadsheets, they're tools for making better decisions, avoiding disaster, and building confidence with investors. Today, we'll explore how to think about startup finance not as a burden, but as one of your greatest strategic assets. Let's start with financial modeling. At its core, a financial model is a roadmap that shows how your startup plans to make money, spend money, and sustain growth over time. It isn't about predicting the future perfectly, it's about building a framework that guides smarter decisions. The first reason financial modeling matters is strategic decision making. A good model helps you decide when to hire, how much to invest in marketing, or whether you can afford to expand to a new market. Without this clarity, decisions are made on gut instinct and risk spirals out of control. The second reason is investor confidence. Investors don't just want big visions, they want defensible numbers. A well built financial model shows them that you understand your unit economics, you've thought through assumptions carefully, and you're prepared to manage capital responsibly. The third is risk management. Financial models allow you to run scenarios. What happens if your customer acquisition cost doubles? What if churn rises by 10%? What if you grow slower than expected? By modeling these situations, you avoid costly surprises and prepare mitigation strategies in advance. In short, financial models don't guarantee success, but they dramatically reduce the odds of failure. They force founders to confront reality and plan accordingly. What goes into a financial model? While formats vary, there are four core components every founder must understand. The first is revenue forecasts. These are built from bottom up assumptions, not wishful thinking. They include your pricing strategy, your customer acquisition projections, your expected conversion rates, and seasonal variations. Good revenue forecasts are grounded in data and logic, not just optimism. The second component is operating expenses. Salaries and benefits are usually the largest line item for startups. Add to that marketing spend, infrastructure costs, and overhead expenses. A disciplined founder knows their expense structure cold and tracks it meticulously. The third is cash flow analysis. This is the month by month reality check. It tracks money coming in and going out, revealing timing gaps between revenue and expenses. Accounts receivable delays, late customer payments, or seasonal cash dips can create crises if you don't plan for them. The fourth is key performance indicators. Metrics like CAC, LTV, churn, and sustainable growth rate validate your unit economics. They show whether your model supports scalable growth or whether adjustments are needed. A financial model isn't about pretty charts. It's about discipline. It's the difference between flying blind and piloting with instruments. Runway is one of the most important concepts every founder must master. Simply put, runway is how many months your startup can survive before it runs out of cash. The formula is straightforward. Runway equals cash balance divided by monthly burn rate. The first step is to calculate your current position. Know your cash balance and your monthly burn rate with absolute precision. Founders who don't know their numbers are gambling with their survival. The second step is to plan strategic milestones. Runway isn't just about survival, It's about buying enough time to hit key goals like product market fit, revenue traction, or your next fundraising round. A longer runway means more flexibility and better odds of success. The third step is to monitor and adapt. Runway must be reviewed monthly, not quarterly. If spending patterns change or if revenue comes in slower than expected, you need to adjust quickly. Delayed awareness is one of the biggest killers of startups. Runway is not a vanity metric. It's a survival clock that tells you exactly how much time you have left to make things work. Burn rate is the other critical piece of the puzzle. It refers to how much money you're spending each month and comes in two forms. The first is gross burn rate, your total monthly expenses across all categories, regardless of revenue. This includes salaries, rent, marketing, software subscriptions, and more. It's the raw pace at which you're burning cash. The second is net burn rate, your gross expenses minus your revenue. This number reflects your true cash loss per month. It's the clearest indicator of how quickly your bank balance is shrinking. For example, if you're spending $200,000 a month and generating $50,000 in revenue, your net burn is $150,000. That means if you have $900,000 in the bank, you have 6 months of runway left. Monitoring burn rate isn't optional, it's the heartbeat of your financial health. Healthy burn should align with your growth stage. In the early days, higher burn may be justified for product development. Later, discipline around burn ensures sustainability and investor trust. The lesson is clear. You don't run out of ideas, you run out of cash. Burn rate tells you exactly how fast you're approaching that cliff. History is full of lessons, both cautionary tales and inspiring examples. Airbnb faced an early cash crunch. To survive, the founders famously sold novelty cereal boxes, Obalaos and Captain McCain's, during the 2008 election. That scrappy move extended their runway long enough to refine their product and secure funding. Creativity saved them when money was short. Quibi is a stark warning, backed by $1.7 billion. They burned through their cash in just 20 months without ever achieving product market fit. Their high burn rate, misaligned strategy, and lack of discipline doomed them despite abundant resources. Zoom, on the other hand, exemplifies disciplined growth. They maintained strong unit economics, scaled gradually, and reinvested responsibly. This discipline allowed them to sustain growth and seize market leadership when the pandemic drove unprecedented demand. The common thread: survival isn't about who raises the most money, it's about who manages it best. Scrappiness, discipline, and clear financial models make the difference between thriving and failing. At the end of the day, financial modeling, runway, and burn rate are not abstract concepts. They are the lifeblood of your startup. Financial models provide the discipline to make smarter decisions, win investor confidence, and anticipate risks. Runway tells you how much time you have to reach key milestones before running out of cash. Burn rate reveals how quickly you're consuming your resources and whether your growth is sustainable. The stories of Airbnb, Quibi, and Zoom illustrate the stakes. Airbnb survived by being scrappy, Quibi failed by being reckless, and Zoom thrived by being disciplined. The lesson is simple. Cash is your most critical resource. Manage it wisely. The final takeaway is this. As a founder, you don't need to be a financial expert, but you do need to be financially disciplined. Numbers won't replace vision, but without numbers, vision won't survive. By mastering financial modeling, runway, and burn rate, you give your startup not just a chance to survive, but the foundation to thrive.